Good afternoon, and welcome to Sensible Financial Planning's webinar, How Can Stocks and Bonds Both Be Down? I'm Carrie Fristow, and I will be your moderator. Today, Sensible Financial's founder, Rick Miller, will talk about the current stock and bond markets. Rick Miller holds a PhD in economics from the University of Chicago and started Sensible Financial 20 years ago this past April. He's also a certified financial planner. You can see all of our past webinars on Sensible Financial's website at www.sensiblefinancial.com/webinars. And you can also register for upcoming webinars through a link in Sensible Financial's newsletter, which will be published later this month. Rick will be taking some well-deserved time off in August, but there'll be another new webinar in September. Just a little housekeeping, please submit your questions through the Q&A link that's at the bottom of your window. Rick will answer as many questions as he has time for. Once, approximately midway through the webinar and once at the end, we will have these question times. Unfortunately, he can't give personal advice in this setting. There just isn't time to gather the proper information. We will display Rick's contact information at the conclusion of the webinar. Now, Rick will begin by highlighting the takeaways from today's presentation.
Thank you, Carrie, and welcome everyone. Stocks and bonds are uncorrelated, and they can be down simultaneously. So even though investment returns so far this year have been disconcerting, with both stocks and bonds having declined in value, and you might be wondering whether this signals a change in the nature of the securities markets. In fact, because stocks and bonds are uncorrelated, they can be down simultaneously. And for bonds always to be up whenever stocks are down would require perfect negative correlation between the two. The reasons for the observed relationship between stock and bond returns are not well understood. People have spent a lot of time trying to understand why the correlation or lack of correlation exists. And I think we can say that they will continue to have a lot of fun trying to figure it out. We can say that interest rates affect both stocks and bonds, and we'll look at that a little bit more as we go on in the webinar. But there are some factors that affect only stocks, and that may not be well correlated with interest rates. So stocks and bonds will then move somewhat independently. Nevertheless, even though stocks and bonds are uncorrelated, holding bonds still helps diversify your portfolio, and we'll talk about that more toward the end. So let's start by looking at what returns have been so far in 2022, and this is not a lot of fun. We have on the chart here bonds at the top. These are the bond returns here, and you see that they're all negative. This is the Barclays aggregate, down 10%. Tips were down 9%, and short tips were down 1.5%. And then down below, we have stock returns since the beginning of the year. And US stocks are down 21%. We're measuring that with the Russell 3000. US tech stocks, and we'll talk more about what we mean by tech in a little bit, but you could think of the FANG stocks, the so-called FANG stocks, Facebook, Amazon, Netflix, Google, etc., as being tech stocks. They've been down more, and we'll talk about why that might be. And then finally, world stocks, which is captured by the MSCI All Country World Index, they've been down just about the same amount as US stocks. Now, I'd like to put that into a little bit of context and look at returns since the beginning of 2020, and that shows, I think, a very different story. You can see that stocks are all the categories of stocks that we're looking at here have had positive returns since the beginning of 2020. And while bond returns have not been exciting, they have not been terrible either. So basically, we've had preservation of capital and some growth of capital over this period of time, despite the fact that the first two quarters of this year have not been favorable. So let's talk now about why it is that bonds have returned poorly in the first half of this year. And the short answer is that interest rates have risen. And we're looking here at yield curve, what are called yield curves. They show interest rates for bonds of different maturities. Treasuries are in orange, so these are nominal bonds, and you see the January yield curve here, and it's demonstrating or presenting the yields on 5-year, 7-year, all the way up to 30-year bonds. And you see that the yield curve is slightly upward sloping, and that the whole curve has risen since January. So the bonds at 5-year maturities went from about 1.5% to about 3%, and the bonds at the long end have gone from about 2% to about 3%. And then if we look at TIPS, which are inflation-protected bonds, they've also increased all across the yield curve. The shorter term ones of 5 years have gone from minus 1% to a little bit positive, and the ones at the longer end have gone from slightly negative to substantially positive at 1%. So interest rates have risen, and you'll recall from the previous two webinars that rising interest rates reduce bond prices, and we'll review this why that is as we go on in this discussion. So I will say that it does seem strange that stocks and bonds are both down. The conventional wisdom is that stocks act, bonds act as a cushion, and they behave differently than stocks. And so I think that when we remember that, we tend to forget the caveats. And I've captured here from Fidelity's website, and I'm not picking on Fidelity, but Fidelity is a reasonably good example of the discussion that you can find if you go online. They talk about stocks as being risky and bonds as being less risky. And then the main point that bears on this webinar is that they say bonds can also act as a cushion against the unpredictable ups and downs of the stock market, as they often behave differently than stocks do. And that's the more accurate statement, which is that bonds can act as a cushion rather than bonds always do act as a cushion. And bonds often behave differently than stocks, but not always behave differently than stocks. And if we look at our experience with historic experience with bonds and stocks, historically it's not unusual for stocks and bonds to both decline in the same quarter. Here we're looking at returns for bonds, and we're representing bonds by the Bloomberg aggregate and stocks by the S&P 500. And we're looking at quarters since 1976, when the Bloomberg aggregate began, when the index was initiated. And out of all the quarters since 1976, and that's almost 50 years of quarters, not quite, maybe 45, that's a lot of quarters, there have been 9% of those quarters when both bonds and stocks were down in the same quarter. And that's now just the reported or the nominal returns. And if you think about that, that's 1 quarter every 2.5 years on average. I'm not saying that out of every 2.5 years there is one, but what that means is that if we looked at 10 years, we'd expect 4 quarters. If we looked at 20 years, we'd expect 8, and so forth. And it also means that it's not at all impossible for there to be 2 quarters in a row like that, or even 3 for that matter. And if we look at real returns after inflation, 16% of quarters have had negative returns for both stocks and bonds. That's about 1 quarter out of every 1.5 years, or 1 quarter out of 6. So that's relatively frequent. It's not strange for bonds and stocks to both be down. Now, this is a different display, but it's the same question. We're looking at bond returns on this axis and stock returns in the same quarter on this axis. And I'm looking for some kind of relationship, or if we were looking for a correlation, we'd be looking for some kind of relationship. And I would invite you to look at that and when I look at it, I don't see much of a pattern. I suppose I could say, well, it looks like the Milky Way from a long distance or something like that. But there's no if we're looking for correlation, we'd expect that we'd see something like that. A positive correlation or a negative correlation would look something like that, right? When bond returns are negative, stock returns are positive. That would be up here, and bond returns are positive and stock returns are negative. That would be a negative correlation, but we don't really see that. And if you do statistical analysis on these data, the statistics quantitatively confirm our visual impression. Stocks and bonds are uncorrelated. That's what these numbers over here say. And we can do a little bit different kind of analysis. We can say, let's look at there we go. We can look at deciles of bond returns. So we can divide the quarters into the 10% of the quarters with the lowest bond returns. That would be over here. And the 10% of quarters with the highest bond returns over here, and then rank them in between. And then we can look at what stock returns are in each of those quarters. And if we were looking for a negative correlation, then we would expect a downward sloping line like that, right? Low bond returns, high stock returns. That's not what I see. If we were looking for a positive correlation, then we'd expect something that would look like that. And you see that at this end, but not over here. So the data, again, are not supporting any kind of correlation. You could say, well, I see a pattern that looks kind of like that, but that's really hard to understand and tell stories about and to have theories about. So basically, this is another way of saying that there really is no correlation between stock and bond returns. So no correlation. So, but we're trying to think about how stocks behave when interest rates rise. And there's no simple answer, but if we think harder about why bond values fall when interest rates rise, then we might be able to have some idea of how they might affect stock returns and stock prices. So let's go back and look at bonds. And here's a very simple bond. It's a 5-year bond with interest payments over the 5 years. And interest rates are really high in this example. They're 10%. And it's a $1,000 bond, so they're paying $100 each year. And then we get our principal back at the end of the 5 years. So the total payments, $1,500, and it's a $1,000 bond. That sounds like a pretty good deal, but interest rates are 10%, and that means that future payments are worth less. And we apply then to the future payments present value factors that bring the future payments back to the present in terms of how much they're worth. And payments 5 years out are worth substantially less than payments at the end of the first year. And let's apply that now to our bond. And we see that with interest rates at zero, then we have our $100 coupon payments and our $1,000 principal payment. But with interest rates at 10%, those coupon payments are worth less and less as we go out into the future. And that principal payment was worth, in present value terms, about $600. So if we add those up, these coupon payments and this principal payment, we get $1,000. If interest rates rose to 20%, then the present value of those coupons would be worth less, right? We're going down here. And the principal would also, the present value of the principal payment would also be worth less, and the price of our bond would drop to about $700. If interest rates drop to 0%, then we'd be getting, it wouldn't matter how far out the payments were, they would be worth the same then or today as they are then, and then present value would be $1,500. So interest rates drop, bond values rise. Interest rates rise, bond values fall. What else can affect bond values? Well, suppose that the borrower, the bond issuer, throws up his hands or her hands and says, sorry, can't pay. The bond issuer defaults. Suppose that the issuer shows up to the bondholders and says, I can only give you 60 cents on the dollar, coupons and principal payment. Then the bond is going to drop in price to reflect that. And in this case, it's going to drop in price by 40% to 60% of its value. And even though interest rates haven't changed. So there's at least one other factor that affects bond prices and bond values, and that is default or inability of the borrower, the issuer, to pay. Okay, let's pause for questions at this point. We've covered a lot of ground, and we actually have a lot of ground to cover in the next section. So let's stop for questions and then come back and look at the effect of interest rates and other factors on stocks.
Okay. So we do have a question from Dwight. He says, I've been hearing about immunization of tips for a safe return for retired people. It sounds complicated and perhaps too good to be true. What are your thoughts?
I think Dwight is referring to immunizing your investment or your investment holdings against inflation and against changes in interest rates. And it's not too good to be true. It's called asset liability matching, and tips are the perfect instrument for that. And the basic idea is to identify on an annual basis your future spending requirements, and one would tend to say future spending needs, the sort of minimum or the amount that you want to guarantee or have very predictable, and then you can buy tips to that in today's present value terms that will deliver the value, the spending power or purchasing power that you need in future years. So suppose that you needed $1,000 10 years from now, $1,000 in dollars of today 10 years from now. Then you would buy a tips that matures in 10 years. You buy $1,000 tips that matures in 10 years, and it will mature in 10 years at whatever in dollars of 2032 would equal $1,000 in dollars of 2022. So you're getting that $1,000 in dollars of 2022 in 2032, regardless of what happens to inflation and regardless of what happens to interest rates. And that is immunization.
Great. Anne asks, why are annuities paying more when interest rates are higher?
Well, I would say, first of all, that we have to think about the two categories of annuities. The first category would be annuities that are already issued. And those annuities are issued and the payouts are set based on interest rate forecasts that were current when the annuities are issued. And those annuity payments, for the most part, don't change. I say for the most part because there are a few annuities, income annuities, where the payouts do change. But in general, annuity payments do not change once they're issued. Now, if we're thinking about annuities that are being issued today, we would expect that if interest rates continue to stay higher, as I suggested in one of my first slides, that we would see payout rates begin to increase. That if the insurance carriers believe that they can look forward and see higher interest rates being paid on bonds, the bonds that they're going to invest, the assets that support the annuities, that if they're going to invest those assets in higher paying bonds, then they're going to be able to make higher payments to annuitants. But it takes time for higher interest rates to sort of work their way through the system and be reflected in annuity payouts. But if interest rates stay elevated, I would expect the payouts to improve on newly issued annuities.
Edward asks if you, Rick, if you could possibly do a quick summary of interest rates up, bond values decrease.
Okay, sure. So let's go back for a moment. I think this is the best. Let's go back even one more slide here. 2 more slides. Okay, so any bond is going to have is going to be characterized by the interest payments that it makes and the principal payment that it makes and the timing of those payments. And in this case, we have a 5-year bond. We bought the bond, or our sample person bought the bond at the beginning of year 1, and at the end of year 1, the first coupon payment is made. At the end of year 2, the second coupon payment is made, all the way out to the end of year 5, when the 5th coupon payment is made, and also principal is returned. And when we're thinking about a bond, and we can fully, for a treasury bond which does not have credit risk, which means that we're extremely confident that the treasury is going to make these payments. So we don't have to worry about default, which would potentially reduce the value of these payments. Then the only question is, how much are we willing to pay for today for this stream of payments in the future? And that's going to depend upon how much we can earn if we use the money, if we invest the money in something else, right? Because we're going to invest our, at least in its sort of standard economic model, we're going to invest our money only if, or to get the best return we can get. So if interest rates are 10%, then we're only willing to pay enough for this stream of payments that we're willing to pay as much as we could sort of use to generate that stream. So if we could buy a CD, let's say, that was paying 10%, then the CD would pay, would add $100 at the end of our first year, another $100 at the end of the second year, all the way out to the end of the 5th year when it would add another 100, and then we'd get our $1,000 back, right? And so at interest rates of 10%, this bond with this stream of payments is worth $1,000, right? Even though we can look at the payments and say, well, they're $1,500 of payments, because we can generate that stream of payments with $1,000 today, that stream of payments is worth $1,000. And that bond is worth $1,000. Now we can, and I'm going to, and this slide just shows you how future payments translate to today. So at 10%, a payment at the end of the first year is worth about 90 cents today. It's actually 91 cents, because if I started with 91 cents and I invested it and I got 10% on it, at the end of the year, I'd have $1, right? And the same with this, for 2 years, it's 82 cents, because if I had 82 cents and I got 10% a year, then I'd have $1, and so forth, all the way out to 5 years, where it's about 60 cents, because if I had 60 cents and I got 10% a year on it for 5 years, I'd have $1. So these are the what we call present value factors. They're the factors that we apply to payments in the future to see what they're worth today, how much we're willing to pay today to get a payment of that size in the future. If interest rates change, then these present value factors change. If interest rates went to 0, then these present value factors would all be 1. Because if I start with $1 today, I'll have $1 tomorrow. If I start with $1 today, I'll have $1 at the end of 2 years, because I'm not earning any interest. On the other hand, if interest rates are higher, then all of these present value factors get smaller. And that's the reason that that bonds decline in value when interest rates rise. Because, and we can go out here now to the next slide. Here are the in blue are the payments themselves, and then the orange is the present value of each of those payments at 10%. And you see that it's smaller than the values themselves, because those are the values that's at 0% interest. And here we're multiplying the coupon payments by the present value factor, and the principal payment by the present value factor, the relevant present value factor, the 1 year, 2 year, 3 year, 4 year, and 5 year present value factors. And then if interest rates are 20%, then those present value factors are smaller, and the present value of those coupons is also smaller. So what we're willing to pay for that bond is less if the interest rates are higher.
Okay. Carl has a question. He says, on an earlier chart, you said that the return on tips was 2.8% over the time frame, which was 2 or 3 years. Was that a positive rate of return?
It is a positive rate of return. It's a positive rate of return, but that's the rate of return on a tips index fund. So that's tips of many maturities, including maturities out to 30 years, right? So that's going to include coupon payments, but it's also going to include changes in the values of the bonds themselves. As interest rates rise, those bonds are going to decline in value, and interest rates have risen, right? That's what we said here, right? Real interest rates, which are the ones that apply to tips, have risen. They've risen by about 1% across the curve, and so that's going to reduce the price of tips. So the fact that the return has been positive means that the coupons that we've been receiving have offset the increase in, or the price decline that's a result of the increase in interest rates.
Okay. And then we have a question from Stephen. TIPS bond funds, okay, do TIPS bond funds in an IRA act similarly to other bond funds? And it says to take advantage of TIPS, one needs to use the asset liability management approach.
So there are two questions in there, and this will be the last question that we try to address in this section. So the first question is, do TIPS bond funds behave the same as other bond funds in an IRA? Mm-hmm. And I think that I'm going to interpret that to mean, are TIPS bond funds taxed the same as other bond funds in an IRA? And the answer is yes. They're not taxed until you take the money out. So that is true. The second question about TIPS and asset liability matching, and whether TIPS are valuable only for asset liability matching, that I would say that that's probably not true. In fact, I would say that is not true, because you can use TIPS for inflation protection even if you're not doing asset liability matching. So as we talked about at length in the last webinar, and I would encourage you to go back and look at it, TIPS protect against surprise inflation, and surprise inflation is unpredicted inflation, which is, I think, fair to characterize the inflation that we're having right now, or have had right now, as unpredicted. 6 months ago or a year ago, people were not expecting it. So TIPS have been very helpful in protecting against inflation, and they will be against surprise inflation in the future. TIPS are also very useful for asset liability matching, as I described. Okay, so let's go on now. Sorry to take everybody through all of these, which we've seen before. Okay, so now let's talk about stocks. And we're going to start by saying that stocks are different than bonds. And we can see sort of direct comparison on a number of items. bonds have a defined maturity. We saw a 5-year bond. Stocks have an indefinite maturity. In theory, at least, they can go on forever. And I'm sure that many of us think of stocks that are of companies that have been available for, I think of IBM, that's been around at least 70 years, and Coke has probably been around substantially longer than that. But it's undefined, because at some point that company might be acquired, and then that's the end of the stock. Then you get a principal payment, which is also undefined, by the way, but that's very different than a bond, where the repayment of principal is specified from the outset. Secondly, income varies. So when we're valuing a stock, we have to forecast the income that we expect the company to generate, and that's quite different than with a bond. So these three factors, which I think characterize bonds very, very precisely, are quite different with stocks. And then stocks are subject to a number of risks that really don't apply to bonds. So the interest rate applies to stocks, but then if we think about other factors, anything that affects the earnings of the company can affect the price of the stock. So product and service demand, resource costs, regulation, and then I've just put 3 dots here because it's almost a list as long as the imagination would allow. And I would say there are too many factors to specify, even if you can buy a prospectus, or not buy a prospectus, but get a prospectus for, let's say, a mutual fund that will enumerate all the factors. And as a professor of mine once said, they're good cures for insomnia. But they can list all sorts of factors that can affect earnings. But even though this list is long, it is still true that interest rates can affect stock prices. So let's look at that directly or specifically. And we're going to look at 2 ideal types of companies. So these are not real companies, first of all. I have made them up, and I've made them up to illustrate the differences between 2 types of companies. And I'm going to call one of them a utility, which has steady value. And the earnings are very predictable, and they are the same every year. And we're going to use the same interest rate or discount rate. We're going to call it 10%. And we're going to get a list of present value factors, just as with bonds. But notice that it goes out a long way. I've run this out 70 years. And I've run the earnings out 70 years. Now, given this set of information with earnings of $100 a year and discount rate of 10%, we can tell, and I will just say that it is not difficult to determine that the price of the stock should be $1,000. But we can look at sort of dividing up that value into the first 10 years worth of earnings, and then the next 10, and so forth, and applying these present value factors for the first 10 years, and then the next 10 years, and so forth. And we can say that the value, or the contribution of the first 10 years of earnings to that value is $614 out of 1,000. That's 60%, 61%. And then the next 10 years bring it to 85%, and so forth. So we get out to 50 years, and we've got 99% of the value. Now, let's look at sort of the opposite kind of company. I'm going to call it a tech stock. And it's got growing earnings. And that means that it has what I'm going to call backloaded value relative to the utility. So here we see the earnings are increasing at 15% a year for the first 30 years, and then they level off. Discount rate is again 10%. And I have picked these earnings to make it so that the stock price is $1,000. Importantly, notice that the first 10 years of earnings represent only 13% of the value. For the utility, it was 60%. So it's very different The value of the tech company is all on the come. It's all based on what people think, what investors think the company is ultimately going to be able to do. So think of Tesla, right? And think of Tesla 2 years ago or 3 years ago when it was unclear whether they were going to be able to make a go of it. And now everybody knows that Tesla's going to do well. But 5 years ago, people didn't. Everybody knows now that Google is going to do well. But 20 years ago, people didn't know. And so those companies at that time looked like this from an earnings projection perspective. And so a lot of the value in the company is way off in the future. Now, when we think about stocks, valuing stocks is enormously difficult because future earnings are not observable. The acquisitions, if they're going to occur, are not observable. Stocks don't have coupons. Company managements may try to project an image of certainty, but they're projecting. So market participants have to forecast earnings, and they have to estimate the discount rates and any changes in those discount rates. And when a stock price changes, market participants have to try to figure out why. Is it a change in forecast earnings? Is it a change in the growth rate? Change in the interest rate? And why is it, right? Is it competition, inflation, supply chain, demand? The list is long. So it's very different than a bond. Well, let's look at what happens to the prices of these stocks when interest rates change. So here's the utility stock, and suppose that interest rates go from 10% to 12%. So we're looking at a discount rate of 12%. Same stream of earnings, $100 a year, but now the present value factors are smaller, right? We see that each one is going down, and I'm just showing the first 10 years of present value factors. And the stock price goes from $1,000 to $833. And notice that also the contribution, the percentage or the importance of the first 10 years of earnings goes up from 61% to 68%. And the first 20 years go from 85 to 90. So the fact that the present value factors are shrinking and shrinking more in the future makes the first few years of earnings more important. Now, let's look at what happens to the tech stock when interest rates rise in the same way, right? So we've got the earnings just the same, right? Growing 15% a year and then leveling off, but the discount rate is now 12%, and the stock price is $634. So the stock has dropped in value by 37% instead of 17%. So, and notice that a higher percentage of the value is arriving earlier, right? Because the future payments are worth less. And let's talk a little bit more about why that tech stock price drops more than the utility stock price. When we're looking at the present value factors, there's a larger reduction, and you can sort of see that visually here, right? The reductions are small for early years. They're big out here. They're falling in half or even more than in half, right? And that's when the big decreases are concentrated out where the earnings are large for the tech stock, whereas the earnings for the utility stock are the same no matter what the date of arrival is. So those later earnings are reduced more by higher interest rates. So the interest rate increase affects tech stock value more. And one story that we could tell about why the NASDAQ is down more than the broader market is that the NASDAQ is full of tech stocks. And a lot of them have income or forecast earnings that are out in the future. And so higher interest rates would affect them more. But interest rates, remember, are not the only factor that affects stock prices. So what else could affect stock prices? The simple ones are earning forecast declines and growth rate declines. And we've got a couple of examples, and I did not do an exhaustive reading of the Wall Street Journal for the last 6 months to see what they said about every tech stock, but I cherry picked. So this is anecdotal. It's not really data. But I cherry picked, or I saw a couple of stories about reduced earnings forecasts. One was for Meta or Facebook. They announced in February that Apple's privacy enhancements for users are going to reduce Facebook's annual revenue by $10 billion. That's $10 billion a year, less revenue. And that Facebook lost users globally for the first time. So that would suggest that earnings are going to be lower for Facebook. And Spotify also declined due to earnings forecast declines. And notice that it says expected subscriber growth is slowing. So we could say, well, that's an example of of a reduced growth forecast. Well, how would those kinds of changes affect stock prices? If earnings forecasts drop by the same amount across the board every year, so if earnings for every year of the utility stock drop by 10%, from 100 to 90, and here I'm showing you the first 10 years up to the blue line, and then from 26 to 35 or 34, I guess, out here. So just so we can see, I want to be able to see changes, and if I show you all 50 years or 70 years, they're just pencil lines. You can't really see what's going on. But notice that we've got a 10% decline, and the stock goes down by 10%. Tech stock, the same. We're reducing every year's earnings by 10%, and the price of the stock goes down by 10%. Now, let's look at a change in growth rates. Suppose that we get a change in growth rate for our tech stock from 15% to 14%, like this. Notice that we get small changes in the original earnings, but big changes out in the future here. And that turns out to have a big impact on the stock price. So the stock, with this very small change in growth rate from 15% to 14%, the stock price falls by 17%. So a 7% change in growth rate, 17% change in the value. Again, because the value of the stock is backloaded, and that compounding of that growth rate has a bigger impact later on than it does early on. So the growth stock is affected by a change in forecast growth rates. Okay, so let's go back to our original question. How do stocks behave when interest rates rise? And the answer is, it depends on what else happens when interest rates rise. If you think about the standard business cycle theory, that says that interest rate rises are driven by improvements in economic opportunities. So you could think of, let's say, the Industrial Revolution, right, where there are opportunities to mechanize and automate and bring manual production into automated settings, and there are very high rates of return that are associated with that. Very high rates of return on investment. So that means that what managers are willing to pay for investment rises. So interest rates rise. So it's the rise in opportunities that drive the rise in interest rates. And so we could have an increase in stock prices even though interest rates rise, because those earnings rise faster than interest rates do. Or growth rates rise faster than interest rates do, or both. So we could have interest rates rise, bond prices fall, but also economic opportunities increase enough so that stock prices rise. So that would be kind of the standard story, right? Because in reverse, economic opportunities diminish, stock prices fall, interest rates fall, bond prices rise. Economic opportunities diminish, stock prices fall, but because the opportunities are diminished, interest rates also fall and bond prices rise. But the standard business cycle theory doesn't apply all the time. Inflation can have impacts, as we've suggested here. But there are lots of changes in the economy that don't follow the standard business cycle theory. For example, the pandemic, supply chain restrictions, the Russia-Ukraine war, the Great Recession, all kinds of things that can have differential impacts on companies and on their stock prices that may have not necessarily the same that the standard business cycle impact on interest rates. In general, because what we saw that bond prices and stock prices are uncorrelated, in general, interest rates and stock returns are uncorrelated. And if we take this seriously, you've got to recognize that stories about how stock prices and bond prices are related are just stories. There's no accepted theory about the relationship. But it is true still that bond returns and stock returns are uncorrelated. The stock and bond returns that we've seen this year are an example of that lack of correlation. We've seen that non-interest rate factors influence stock prices, and we've provided some ideas about why we might have seen the stock and bond performance that we've seen so far this year. So all that said, you might be thinking or might be wondering, well, wait a minute, I thought that the reason I had bonds in my portfolio was to protect me. So when stocks drop, my bonds are going to rise. And if that's not true, then why do I have bonds? And there's a very good answer to that question. And it's called diversification. And even without negative correlation, we can still get significant diversification. And here's a really simple example, and I'm going to use just stocks here, but it works just as well for stocks and bonds. But I'm using just stocks because the answers or the examples seem to be easiest to explain and easiest to understand. So suppose that we can buy a stock and it's got easy to understand returns, even if they're unpredictable. So the company has good years and bad years. And good years occur half the time and bad years occur half the time. And in a good year, the company earns $20. And in a bad year, it loses 10. So let's look at the payoff stream here from that. So here it is. If we've got one stock, half the time we're going to earn 20, half the time we're going to lose 10. On average, we're going to make 5. On average, if you put that together, we're going to make 5. Now, that's kind of risky, right? Because we could have 2 years in a row, 3 years in a row where we lose 10. That's not much fun. So we look around and we find there's another stock with the same payoff pattern, but it's uncorrelated. So in good years, it pays 20. In bad years, it pays 10, it loses 10. But what stock 1 does and stock 2 does are completely unrelated. So now let's look at the payoff pattern. With 2 stocks, now we can see that the average payoff is 5, but now we've got a lot of payoff here in a lot of years where we make 5. And the number that we're only going to lose 10 in a quarter of the years now instead of in half the years. We're only going to make 20 in half the years also, but there's less risk of loss. If we could do it for 2, we could do it for 3. Let's look at 3. With 3 now, the chances of losing 10 are down to 12.5%. And the chances of making 20 are also only 12.5%, but we're still on average going to make 5. Let's go to 4. Now our chances of losing 10 are down to 6%. And if we go to 8, our chances of losing 10 are minuscule. And this is beginning to look like a bell curve. And it's a bell curve that's got a lot less risk than that initial payoff stream that we looked at with 20 half the time and minus 10 the other half the time. Okay, so by taking our investment and dividing it evenly among 8 stocks that have the same kind of pattern of returns, we reduce our risk a lot. And that is the best. So we get the same expected return, less risk. That's diversification. That's what they call the only free lunch available. Now let's look at the same thing, but now with stocks and bonds. Okay, so again, we're looking at, now I shouldn't say again, we're looking at different levels of correlations between stocks and bonds, and we're looking at the risk-return trade-off. So we've got real return on this axis, low to high, and we've got risk on this axis, low to high. And if stocks and bonds were perfectly correlated, so that whenever stocks are up, bonds are up by the same relative percentage, right? Then this is the return stream that we can get, or this is the opportunity set that we face, right? We can get anywhere between 1% return at 5% risk, which is the bond return, up to 5% return at 15% risk, which is the stock return. And as we vary between stocks and bonds, the proportion between stocks and bonds, this is the trade-off we face. Now, suppose that instead of 100% correlation, there are only 50% correlated. So positively correlated, it's more likely that when bonds are up, stocks will be up, but not always. Then we get some benefit from diversification, right? We get this, we're on this curve here, which means that we can get more return for the same amount of risk that we could have gotten if there were perfect correlation. And if we go to uncorrelated, which is the case of 0% correlation, we get even more diversification benefit. So there's substantial diversification benefit available with the fact that stocks and bonds are uncorrelated. Now, it would be nicer if stocks and bonds were negatively correlated, then we'd get even more return opportunity for less risk. If they were perfectly negatively correlated, we'd be all the way up here. Life doesn't always work the way we'd like it to. So that perfectly negatively correlated investment idea is not available. But we do get no correlation. And having bonds in our portfolio allows us to take advantage of it. And Carrie, we're ready for questions again.
Okay, great. Okay, here is a question. I believe you answered the first half of his question already, your diversification explanation. But he also wonders, do you think the allocation of bonds to stocks should change based on recent activity?
Should you change your allocation between stocks and bonds based on what we've seen? And the short answer, I would say, is no. Right? I would say that we've not learned anything new about securities markets from the last 6 months. I can give you the principle. Stock returns and bond returns are unpredictable. Stocks are riskier than bonds. Stock and bond returns are uncorrelated. Stock returns on average are higher than bond returns. I mean, those are kind of the basic principle, and none of those have changed. So in terms of forecasting what returns are going to be going forward, I don't think and relative returns and relative risks, I don't think we've learned anything. So in general, we don't recommend that people change their allocations based on how their views about market returns have changed, because we know that in general, none of us is any good at forecasting what market returns are going to be. So it's unwise to make changes to our allocations on that basis. If one's personal circumstances have changed, then it may make sense to change the allocation. But that's an individual specific question.
Okay, we have Dwight asks a question. He says, Scott Burns and others have advised low-fee funds like Vanguard for self-management of investments. But Vanguard has become a behemoth. And he says it seems like the baby boomer retirement bubble has settled in these types of funds. Is that good, bad, or does it matter for future returns?
Oh, that is one can make that a very complicated question. One can get into questions of governance of companies, and there are, I think, legitimate concerns about whether the portfolio managers of funds at Vanguard, at BlackRock, those are the two large index players, whether they accurately reflect the views of their shareholders when they're voting proxies and they're in effect advising boards of companies on what they ought to do based on what their shareholders believe. I think that's a problem. But in terms of the net returns to investors, I think we've never had a better time to be an investor. The costs of investing are way lower than they were even 10 years ago. But if you contrast it to 20 years ago or 30 years ago, much lower. And the net returns that one receives are the returns to the gross returns minus your costs. If your costs are less, your net returns are more in any environment.
So Jill asks, what percentage of bonds do you recommend in a portfolio?
That is a determination that is based on an individual's or couple's or family's risk capacity and risk tolerance. And the more risk capacity a family or a couple or individual has, or the more risk tolerance they have, the more stock, the higher percentage of stock they can have in their portfolio. And we encourage people to hold the amount of stock that is the lower allowed by their risk tolerance and their risk capacity. And risk capacity is related to the amount of surplus in your financial plan. If you have many more assets than you need to support your planned spending over the rest of your life, you have a large surplus, you can afford to take a lot of risk, because even if that risk turns out badly and you use up some of that surplus, you still have enough to do what you want to do. On the other hand, if you have no surplus, we don't think you have capacity to take risk.
Let's see. Do you have any suggestions to hedge interest risk for one's bond portfolio other than going to cash or ultra short funds?
I would encourage you, first of all, to go back and look at the webinar, the first webinar we did in this series, because that talked about the impact of interest rates on the liability side of your balance sheet as well as on the asset side of your balance sheet. And I think that's helpful in thinking about this question of hedging risk. I think it also talks about the difficulty of forecasting changes in interest rates well enough so that the actions that you're talking about will actually work out in your favor. Because to say, let's say, we'll go to ultra short or go to cash, when you do that, you're implicitly saying, well, I know that interest rates are going to go up, and I know that I can find the time to go back into longer bonds of longer maturities, where interest rates have gone up enough so that my net return from bonds starting at that point is going to be better than my net return from cash. And that's a very difficult calculation to do. It's forecasting that any of us would love to be able to do. And in that first webinar, I suggested that if you can really do that well, whatever you're doing beside that, you can give up as your day job, because you can make an enormous amount of money if you can forecast interest rates. But people don't seem to be able to do it because we have not observed that the number of people buying private islands has grown dramatically over the last little while. It's just I don't encourage people to try to time the market, and moving from bonds to cash and anticipation of interest rates going up and then planning to go back in is exactly that.
Okay, one last question. What are your thoughts on target retirement date funds?
I think I think several things about target date funds. I think that especially for people whose entire portfolio is in a 401k and is not interested in or is very uncertain about how to manage that 401k, I think target date funds can be very helpful because they're a kind of a default choice, and one could do a lot worse than the target date fund. I think that if you have assets outside the 401k, then it's important to try to coordinate the target date fund with your other investments, and that may take more work. And I would also say that target date funds vary. The Vanguard fund and the Fidelity fund and the T. Rowe Price fund are all different, and their investment strategies are different, and their asset allocations are different. So it's important to understand what your target date fund manager is doing, what their strategy is, and compare that to your risk capacity and risk tolerance, because you may find that the manager is taking more risk or less risk than you would prefer to take. And Carrie, we're over time here. I think we could do one more, and then we should finish up.
Okay. But there is another question. Where does real estate fit in between stocks and bonds in this inflationary cycle?
That's an excellent question. Real estate, as the name suggests, is a real asset, and one would expect that it would maintain its value in the face of inflation. I think that we can distinguish between individual real estate assets and real estate mutual funds. Individual real estate assets do have that real aspect to them, and that's an advantage in an inflationary time. They're concentrated assets. They're not diversified assets. So if, for example, you had one piece of rental real estate, you may get very good inflation protection from it, but it's not well diversified. So if that particular piece of real estate declines in value because I don't know, it's commercial real estate in New York, and commercial real estate occupancy rates in New York are 45%, and so it's not unlikely that I should say that. Let me not be specific to New York. Let me just say that the relative values of real estate by market are uncertain and they're risky, and so you're trading off the concentration risk against the inflation risk, and it's not obvious which way that works. You can also buy real estate in a mutual fund, then you're going to get better diversification, and you should have inflation protection from that. But I wouldn't recommend that you go and put all your money in a real estate fund, because again, then it's not going to be well diversified. So I'm afraid that there's no clear yeah, you should do this. No, you shouldn't do that kind of answer here, I'm afraid. Okay. All right. So I think we're close to out of time. I'm going to move on and summarize the takeaways. And here they are. So they are quickly, stocks and bonds are uncorrelated, not negatively correlated. And we tend to think of negatively correlated as our kind of, that's what we tend to hear when people talk about stocks and bonds not always behaving the same way, but they're not negatively correlated, they are uncorrelated. So knowing that one is up, we can't really predict what's happening to the other. Stocks and bonds have declined together in the past, and we saw that they've declined in the same quarter quite frequently in the past. They're almost certainly going to decline together again in the future in quarters and 6-month periods. And this year's concurrent decline in stocks and bonds doesn't provide news about how markets work. It's not completely unanticipated. It doesn't send us back to the drawing board to understand how stocks and bonds work. And finally, even if they're only uncorrelated with stocks and not negatively correlated, bonds in your portfolio provide an important diversification benefit. And so it doesn't require, or doesn't even indicate that you should change your the way your portfolio is allocated because the world is different than you thought. The way your portfolio is allocated takes into account the correlation of stocks and bonds, or should take into account the correlation or non-correlation of stocks and bonds. And we haven't learned anything that would cause us to change what we're doing. Okay, so that concludes the webinar. Thank you very much for coming. As Carrie said, you can find, or you will be able to find, a taped version of this in a link to an email that you should receive. And thank you very much for coming. Have a great afternoon.